Good evening, students. I welcome you all in our today's session, the revisionary class of salary and income from house property. So I believe you all are doing good and study very hard to achieve the goal of your life to become a chartered accountant as soon as possible. So I asked you all in the last session that if you want to understand the revisionary class in a better way, please do revise the topic once. So that is definitely going to help you a lot when you will join these classes. So as in the last session, we have completed basic concept provision and residential status provision. In today's session, we will cover salary topic, revisionary questions, MTP questions, and case scenarios, as well as the income from house property question. Before starting the practical part, let me discuss with you the basic important things under these two chapters. If we talk about salary, you have to be very careful when you solve a question of salary in your examination. The reason is under default tax regime and under optional tax regime, the treatment of certain allowances, deduction completely change. So when there is a question which is regarding salary income, you have to be very careful that whether you are falling under default tax regime or optional tax regime. Why? Because under default tax regime, you have to remember the standard deduction would be 75,000. And under optional tax regime, this deduction would be reduced to 50,000 rupees. Understood? There are certain exemption of allowances, etc., which are not allowed under default tax regime. If we talk about certain these kind of exemption, there is LTC, not allowed under default tax regime. HRA, house rent allowance, is not allowed. Okay, now who will tell me any other allowance or deduction which is not allowed under default tax regime? I have explained LTC and HRA. Now, can you tell me any other? Let me see if somebody answered. Meg is saying, good evening, sir. Please uploaded the answer part of last class revision. Meg, I have tried it, but there is some problem on the portal. So I won't be able to upload it. As soon as the portal glitch will solve, I am definitely going to upload it. Okay. Soumya is saying, good evening. Good evening, Vishakha. Good evening. Aditya is saying, donation. In case of salary, which kind of donation we are discussing, Aditya? Entertainment allowance deduction. Very well done, Amal. Entertainment allowance deduction as well as professional tax deduction. So in case of salary, the entertainment allowance deduction and professional tax deduction is not available under default tax regime. As well as there are certain special allowances. Those are not allowed under default tax regime. One is helper allowance, that is only allowable under optional tax regime as per the provision. Next is research and academic allowance and uniform allowance. So we have discussed regarding these allowances. These are part of special allowances and these are only available under optional tax regime. Under optional tax regime, we have discussed certain provisions, and under default tax regime, there are certain deduction, etc., which is not allowed. So you have to be very careful. When you are solving a question of salary, you should always be very attentive. Whenever there is an allowance, deduction, etc., provision has been given, you have to recall once that whether it is allowed under the regime, whatever you are solving in that question. Next is topic what we are going to cover today is income from house property. Again, in case of income from house property, the regime affect your solution, whether you are under optional tax regime or you are under default tax regime. So in case of default tax regime, in case of house properties self-occupied, you cannot claim interest deduction. So if the property is self-occupied under default tax regime, even if you have taken the loan, there is interest, whether it is current year interest or pre-construction period interest, but you cannot claim it under default tax regime. So I can say in case of property self-occupied, in case of default tax regime, and if it is not going to be treated as deemed let out, the value will always be nil from that property. But in case of self-occupied, you can claim a deduction of maximum 2 lakh rupees in case of self-occupied property. And this deduction could result in a loss of rupees 2 lakh under the income from house property, and this can be set off. The maximum loss set off from interhead sources is also capped at 2 lakh rupees. So these are major things which you should keep in your mind when you are solving a question of salary and house property under different regimes. So now one by one, we will solve some question. So that will help you to understand the concept. There will be some question which is very interesting and different from the other ones also. Let's get started with our question number 1. This question 1 says, Mr. Sahil, a resident individual, age 40 years, is an assistant manager of Fox Limited. He's getting a salary of rupees 55,000 per month. During the previous year 25-26, he received the following amount from his employer. As I have always asked, whenever you are going to solve any practical question, you have to see the requirement of the question. So the question requirement is compute the income under the head salaries of Mr. Sahil for the assessment year 26-27 if he is paying tax under default tax regime under section 115 BAC. So we have to calculate income under the head salary if he is under default tax regime. So now we will solve this question by discussing one by one all the points. So first of all, he is getting salary of 55,000 per month. So that would constitute as my basic salary 55,000. That means 6,60,000 rupees. Now second is dearness allowance, 10% of basic pay, which forms part of salary for retirement benefit. That is also a very important thing we have discussed in the live classes. In those classes, I have told you, whenever there is dearness allowance has been given in the question, always write it down, whether it's as per terms of employment or not as per terms of employment. So in this example, you can see the dearness allowance value is 10% of basic pay. That means 66,000 rupees. And as the question say, it forms part of your retirement benefit. So just write it down, this T, that means terms. So you will always remember that I need to include this dearness allowance whenever there is a requirement of inclusion of dearness allowance if it is on the basis of terms in employment. Clear? So please make it a habit. And whenever there is dearness allowance, you have to write it down whether it's as per terms of employment or not. After that, there is bonus of rupees 60,000 is there. So that is also going to be taxed. Can you tell me the importance of this DA as per terms? Can you tell me 2 or 3 examples in which cases this DA terms need to be included under the head of salary in 2 or 3 of calculation? So just I want to see that whether you have revised or not. So please tell me 2 or 3 cases in which DA as per terms of employment is required to be included for the purpose of calculation under the head salary. Let me see. HRA, well done. Ketan. Gayatri is saying to calculate taxable gratuity and HRA. Which case of gratuity, Gayatri? Gratuity is having 3 cases. A, B, and C. Government employee, covered under Payment of Gratuity Act, not covered under Payment of Gratuity Act. So in which case do we need to include dearness allowance? Amal is saying HRA. Vishaka is saying gratuity C cases. Ketan is saying gratuity C case not covered. Aditya is saying reimbursement, sir. Okay. So in case of gratuity B case, all DA need to be included as per term or non-term. But in case of C case, we need to include only DA, that is as per terms of employment. Okay. So of course, HRA, DA for gratuity purpose, and we have also that calculation for provident fund, we need to include leave encashment. In all these cases, DA as per terms of employment required to be added. So after bonus, fixed medical allowance of rupees 50,000 for meeting medical expenditure. Now you can see in this case, fixed medical allowance of 50,000 for medical expenditure. So can you tell me the treatment of this? Do we need to taxable this allowance, or is there any exemption regarding this? What is the correct answer? Aditya is saying taxable. Anyone else? Whether it's going to be taxed or exempted. The correct answer is fixed medical allowances are fully taxable. So this medical allowance is also going to be taxed completely. Next is he was also reimbursed the medical bill of his mother dependent on him, amounting to rupees 6,500 rupees. So now can you tell me the treatment of point number 4? Is it going to be taxed or exempt, students? Vishakha is saying exempt. Aditya is saying exempt. Why it is exempt? The medical facility or the medical perquisite only exempt if it is provided by a hospital which is maintained by the employer, or if it has been provided from a government hospital in case of specified diseases. But there is no such condition mentioned in this situation. So this 6,500 is going to be taxed. Medical facility. Next is Mr. Sahil was provided with a laptop both for official and personal use. Laptop was acquired by the company on 1st June 2023 at rupees 35,000. So what is the treatment of using a laptop for official and personal purpose? We have gone through in the lectures of salary. So whether it's going to be taxable or whether it's going to be non-taxable. Very simple provisions. Miss Mac is saying fully exempt, sir, because fully depend on him. The taxable value would be nil. Correct, Vishakha? Correct, Gayatri. Laptop is a non-taxable perquisite. So the taxable value would be nil in this case. Further, a domestic servant at a monthly salary of rupees 8,000, which was reimbursed by the employer. Now, this is going to be an obligation of an employee met by employer. So this is going to be taxed. So the total taxable value would be 96,000 rupees. Point number 6. Fox Limited allotted 700 equity shares in the month of October 2025 at rupees 170 per share against the fair market value of rupees 280 per share on the date of exercise of option by Mr. Sahil. So if you get shares at reduced cost, the difference is going to be a taxable perquisite. So as you can see, the market value was 280 and the price paid by me is 170. So 110 is the value which is received as a perquisite. And for 700 equity shares, that would amount a taxable perquisite of 77,000. Next is professional tax of rupees 2,200, out of which 1,400 was paid by the employer. So can you tell me the treatment of this as a perquisite? How much amount need to be added back as a perquisite in the hands of employee regarding point number 7? Aditya is saying 1,400. Anyone else? Vimanyu is saying 14, Saurabh is saying 14, Gayatri is saying 14. Well done, everyone is correct. The amount paid by employer would constitute as a perquisite in this case. So of course 1,400 is going to be the taxable value of perquisite in respect of point number 7 we have discussed. So after adding all these things, the gross salary would be 1016900. And because we are under default tax regime, so the standard deduction would be 75,000 rupees. Now, can you tell me that can we claim professional tax deduction or not in this scenario? The answer would be no, because professional tax deduction can be claimed only under optional tax regime. So the net salary would be 941900. I hope it's clear. Anyone have any confusion in this solution, students? Any confusion in this question? Okay. Moving on to second question. Mr. Kushal is a resident, but not ordinary resident in India during the assessment year 26-27. So the residential status is resident, but not ordinary resident. He furnished the following information regarding his income or expenditure pertaining to his house properties for the previous year 25-26. He owns two houses, one house in New York and the other in Ahmedabad. So he is having two houses, one in New York and one is in Hyderabad. We can solve it over here. The house in New York is let out there at a rent of rupees $5,000 per month. The entire rent is received in India. He paid property tax of rupees $1,250 and sewerage tax $750 there. $1 value is INR 81 has been given in the question. The house is in Ahmedabad is self-occupied. So the house is in Ahmedabad is self-occupied. he had taken a loan of 30 lakh to construct the house on 1st September 2020 at 10% rate. The construction was completed on 31st May 2022 and he occupied the house on 1st June 2022. Entire loan is outstanding as on 31st March 26. Property tax paid in respect of the second house is 2800. Now the requirement of question. Compute the income chargeable under the head income from house property in the hands of so and so if he has opted out of the default tax regime. So technically, we do need to calculate his income under optional tax regime. So one by one, we will solve it. So one property is let out, actual let out, and one is self-occupied under optional tax regime. For the self-occupied property, whether it's outside India, we have to calculate this in the hands of the assessee because rent is received in India. He is a resident, but not ordinary resident. So if you are a resident and not ordinary resident, the rent, if received in India, is going to be taxed in India. So in this situation, the GAV would be $5,000 for 12 months multiplied by INR value. So the GAV would be 486,000. Out of this GAV, the taxes, the municipal taxes paid outside India would also going to be reduced. So it is 1250,750. That means $2,000 into 12 into 81. So that will be 1,62,000 rupees. The net annual value would stand for 4698000, and we have to reduce 30% of standard deduction, which will be 1,409,400. Now the value or the income from house property would be 32,88,600 rupees. I hope it's clear till now. Now let's calculate the value of self-occupied property. In case of self-occupied property, which was in Ahmedabad, the value would be nil because it is self-occupied. We can claim only interest deduction in this scenario, whether it's current year interest or 1/5 of pre-construction period interest. As you can see, the loan amount was 30 lakh rupees and there is no repayment has been done. So the current year interest would be how much, student? 10% of the loan value. This would be the current year interest, that is 3 lakh rupees. In this case, we have to calculate the pre-construction period interest also. And for the purpose of calculating pre-construction period interest, first of all, we have to find out the pre-construction period. As we have discussed in our normal lectures, that pre-construction period calculation would be from the date the loan taken till the date of loan is repaid or the 31st March preceding the date of completion of the property. So if you can see in this question, we have to find out the loan taken date and loan repaid, which has not been done yet, or 31st March preceding completion of the property. Can you tell me the loan taken date? Okay, let me tell you the loan taken date. The loan taken date has been given 1st September 2020. Now, please tell me this end date, which should be 31st March preceding the date of construction or purchase of the property. Abhimanyu is saying from 1st September 20 to 31st March 22. And 31st March 22 is the ending date as per Gayatri, as per Vishakha. Absolutely correct. Because the house has been completed on 31st May 2022. So the March before this date would become the end date, 31st March 22. So my pre-construction period would be this. How much? It would be 19 months. So I have to calculate the interest of 19 months. On the basis of that, we would be able to calculate the pre-construction period interest. So 30 lakh was the loan amount, 10% interest, and we have to calculate it for 19 months. So that would be 4 lakh 75,000. And we can claim 1/5 of it every year. That would be 95,000. So current year interest was 3 lakh and 1/5 of PPI would be 95,000. Total aggregate deduction is 3,95,000. Now, can you tell me how much maximum we can claim in case of self-occupied property? 475, 2 lakh only, of course. The correct answer is, of course, 2 lakh rupees. The maximum deduction we can claim is only 2 lakh rupees. So the Ahmedabad property loss would be 2 lakh and the profit of New York is 3288600. Now my one question to all of you. Can we set off this loss against the income of New York property? Can we set off this 2 lakh against 32 lakh 88,600 or not? Gayatri is saying yes. And of course, Gayatri is correct. We can set off this loss and after that, the income from house property would be 3088600. I hope it's clear, students. Any query in this question? Anyone of you have any query, you can ask me. Very good. Sridhar is saying clear. Nice. Chalo. Question number 3. Priyanka, General Manager of ABC Limited, Mumbai, furnish the following particulars for the financial year 2025-26. Salary 40,000 rupees per month. Okay. Value of medical facility in a hospital maintained by the company 10,000. Rent-free accommodation has been provided. Housing loan value has been given in the question. Dining table provided. Personal purchase through credit card. Maruti Suzuki car has been provided, etc. But first of all, I want to know what is the requirement of question. Compute the gross total income of Priyanka for assessment year 26-27. If she exercised the option to shift out of the default tax regime. That means we have to solve this question under optional tax regime. Clear? So now let's solve this. First of all is salary. So basic salary is 4,80,000. Value of medical facility in a hospital maintained by the company. So medical facility would be, what is the treatment? Whether it's going to be taxable or it's going to be exempted, students. Gayatri is saying exempted, Sridhar is saying exempted, Vishakha is saying exempted, Mehak is saying exempted. Well done, everyone. Why it is exempted? Will anyone tell me why it is exempt? What is the reason? And the correct answer is exempted. Yes, Abhimanyu, absolutely correct. Because maintained by employer. High five from Wi-Fi to all of you who gave correct answers. Because it is maintained by employer, that's why it's going to be a tax-free perquisite, non-taxable. Now, rent-free accommodation for the purpose of rent-free house, which is owned by the company. What the rule says? It says a certain percentage is required to be taxed because we are talking about Mumbai. So the percentage would be 10% of salary. That would be 48,000. The next is housing loan. So if you receive housing loan at concessional rate in comparison to SBI rate, that concession is going to be taxable value. Now, in this point, you have to calculate that taxability of interest. Housing loan is 7 lakh given on 1st April 25 at the interest rate of 6% per annum. The rate of interest charged by State Bank of India as on 1st April 25 in respect of housing loan is 9.5%. So can you calculate the taxability of this perquisite in this specific situation? What should be the taxable amount in this case? Okay, Manu is saying 24,500. Gayatri is saying 24,500. Saurabh is saying 24,500. And Vishakha is saying the same answer. Well done. The correct answer is, of course, 24,500. That would be 3% of 7 lakh. Well done. Now, a very interesting point is here regarding our dining table. A dining table was provided to Priyanka at her residence. This was purchased on 1st June 2022 for rupees 60,000 and sold to Priyanka on 1st May 25 for rupees 30,000. Now, can you tell me, in this point, there is a movable asset which has been transferred to employee. So can you tell me whether the provision of transfer of movable asset would be applicable or use of movable asset would be applicable in this point number 5? Student, please calculate it. It's a very important point. अशोक सर एक 2 मिनट का ब्रेक ले सकते हैं अभी? अशोक सर, अशोक सर को कॉल करते हैं. बच्चों, आप लोग क्वेश्चन सॉल्व करो. सर 2 मिनट का ब्रेक ले सकते हैं? मैं आपसे बोल रहा था वहां पर, लेकिन आप है नहीं उधर. एक अभी 2 मिनट का ब्रेक लेना है, फिर उसके बाद उधर बाद में ले लेंगे 7:30 के बाद. ठीक. So we were discussing this point. I guess I forgot to share the screen. So let me see. Now, can you answer? Is it a question for use of this dining table or transfer? So you have to be very, very careful when these asset utilization or transfer case has been given in the question. So what is according to you? So somebody is saying transfer, somebody is saying that is for use, but the correct answer it's both. If you'll read this point very carefully, you will understand why it is both. Because a dining table was provided to Priyanka at her residence. That means it has already been provided to Priyanka from starting to use. It has transferred to Priyanka on 1st May 25. So from the date it has been purchased, it has been given to the employee for use. So Priyanka was using it from the day of purchase. But now on 1st of May 25, this asset has been transferred to Priyanka. So that means if she was using this asset from 1st June 2022, this asset is with Priyanka. And this has been sold to her on 1st May 2025. So in our financial year 25-26, in April 25 also, she was using. So in current financial year, she used that dining table for 1 month, and after that it has been transferred to her on 1st of May. Suppose if the date is not 1st May, suppose it is 1st of August. In that case, April, May, June, July, the 4 month use treatment needs to be done, and then the transfer treatment needs to be done in this point. So now we will calculate the taxable value of a perquisite for 1 month of use, which would be 10% per annum basis on the actual cost. So 60,000, 10% for 1 month. That would be 500 rupees. Clear? And now this asset has been transferred on 1st of May, which has been purchased on 1/6/22 by employer and transferred to on 1st May 2025. Now, in case of asset transfer, there is a concept which says that for each completed year of asset used or held by employer, depreciation would be provided. So can you tell me between this duration, for how many completed year this asset has been owned by the employer? How many completed year I should allow depreciation? Vishaka was correct. Gayatri is saying 3 year. Anyone else? 31 months. Adit, I am asking just completed year of completed years. So months is not required. I just wanted to know how many completed year it has been owned by the employer before transfer. And the correct answer is 2 years. Because from 1st June 22 till 1st June 23, then from 1st June 23 till 1st June 24 would be 2 years. On 1st June 25, that could be 3 years. But before that, it has been transferred. So technically, it is 2 years and 11 months. And we need to consider only year in this case. So we will charge depreciation for 2 years as per SLM method. The value was 60,000. Depreciation as per SLM method would be 6,000 at the rate of 10%. For 2 years, it would be 12,000. So as per income tax, the dining table value was 48,000. And this has been transferred to employee at 30,000 rupees. So 18,000 would be taxable value. So 500 is for use and 18,000 for transfer would be the taxable value. Abhimanyu is asking transfer after 3 years. If it has been transferred after 3 years, suppose the asset is not transferred on 1st May, it has been transferred on 1st August, then we will take 3 years and that would be 18,000 and then we need to solve accordingly. Next, personal purchase through credit card provided by the company amounting to rupees 10,000 was paid by the company. No amount was recovered from Priyanka. So this is again obligation of employee met by employer and going to be taxed. Next is a Maruti Suzuki car which was purchased by the company on 16th July 23 for rupees 2,50,000 was sold to the assessee on 14th July 25 for rupees 160. Now you can see there has not been any word as being used in this dining table word. The dining table was provided to Priyanka. Now in this case, only asset has been transfer. No use case has been given. So again, I will ask you, can you tell me how many completed year in this case now? Vishakha is saying 1 year. Abhimanyu is saying 2 year. Sridhar is saying 1 year. Mac is saying 1 year. Well done. Of course, it is 1 year. Because on 16th July 25, 2 year would have been completed. Now it's almost 1 year, 11 months, and 28 days, etc. So now in this circumstance, we have to charge the depreciation for 1 year. How much depreciation rate is required to applicable in case of car? It's 20% WDV base. Very good. So in this case, now 2,50,000 rupees value, depreciation at the rate 20% need to be applied. So 2 lakh rupees would be our value, which has been transferred to employee at 1,60,000 rupees. So remaining 40,000 would be taxable value in this circumstances. Other income received by assessee during the previous year, that is the part of income from other source. Whatever we have solved above regarding salary part, the gross salary would be 6,21,000 and deduction would be 50,000. So net salary is going to be taxed as 5,71,000 rupees. Clear, students? Any confusion in any point, you can ask me in this question. Yes, very well done, guys. The interest amount, we have calculated interest amount, 24,500 rupees we have calculated. Which interest amount you are talking, Gayatri? Yes, Abhimanyu. We do not check from financial year assessment year. Complete year means the day you purchase and the date you transfer. And on that basis, you have to find out how many completed years are there. Okay? Chalo. Moving on to next. Okay. Mr. Ram, an employee of the central government, is posted at New Delhi. He joined the service on 1st February 2021, details of the income are as follows. Basic salary 380, DNS allowance 120, both Mr. Ram and government contribute so much amount in NPS. Gift received by Ram minor son from birthday. This is a part of income from other source. Ram gifted, etc. Again, this is also not part of our salary topic. Ram deposit is again deduction part, not the part. Again, this is also deduction part. Okay, so these were the relevant information. Ignore the provision under section 115 BAC. That means we have to solve this question as per optional tax regime, students. For the purpose of optional tax regime, as you can see, we have to take the basic salary into the calculation. Clear? Then we need to consider dearness allowance, that is 1,20,000. And of course, as per term is 40%. So we have to mention 40% as per terms of retirement benefits. Now, next is Mr. Ram and government both contribute 20% of the basic salary to the pension scheme referred to in section 80 CCD. So can you tell me the treatment of this point under the head salary? What should I do? Mac is saying exempt. No, that is not the correct treatment. Anyone else? Mac is saying, sorry, sir, it's deducted. What deducted? I am asking what should be the treatment of third number point under salary head. If you're talking about deduction, I'm not asking that. Abhimanyu is saying up to 12% exempt. Abhimanyu, that is a treatment for recognized provident fund, not for this NPS. What is the treatment of point number 3, students? Gayatri is correct. Would form part of salary. So whatever employer contribution for NPS, etc., that is going to be the part of your salary first. So this 76,000 is going to be the part of your salary. And of course, you can claim this deduction later on, but initially it's going to be the part of your salary income. So your gross salary would be 5,76,000 rupees less 50,000 deduction. So the balance is 5,26,000. Of course, I believe there is nothing to ask in this question. So we are moving on to the other question. Even if you have any query, you can tell me. Next is Mr. Selesh is a marketing manager in Smile Limited. For the following information, you are required to compute his income chargeable under the head salary. For assessment year 26-27, he has opted out of section 115 BAC. That means we need to calculate tax under optional tax regime. The basic salary is 70,000 rupees per month. DNS allowance 40%. So starting से start करते हैं basic salary, that means 8,40,000. DNS allowance is 40% of basic salary, that would be 3,36,000. Now, can you tell me whether this DA is as per retirement terms or not? If nothing is mentioned, how we treat it. You see, no. Gayatri is saying no. What is meaning of no? It is DA non-term. If nothing is mentioned, always treat it as a non-term. In short, you can write it down NT. Next is, he's provided health insurance scheme approved by IRDA, for which rupees 20,000 incurred by Smile Limited. So what provision we have discussed in case of health insurance if paid by employer, whether it's going to be taxed or not? Is it an exempt perquisite or is it taxable? Sridhar is saying exempt. Gayatri, Saurabh, Mehak, all are saying exempt. Well done. Of course, this is not going to be taxed, non-taxable. Received rupees 10,000 as gift voucher on the occasion of his marriage anniversary from Smile Limited. So what is going to be the treatment of this point? So there was a concept we have discussed under normal classes that gift or voucher up to rupees 5,000 is exempted. And now there are two opinions. If it is exceeding 5,000, either you can tax the full value or you can tax the excess also. Both views was there. So you can mention what view you want to follow, but I will prefer that if it is exceeding 5,000, in my opinion, you need to tax it completely. That means gift voucher 10,000. For example, if it has been 6,000, let's tax it complete 6,000 rupees. Okay? Sure. Next. Smile Limited allotted 800 sweat equity shares in August 2025. The shares were allotted at rupees 450 per share. And the fair market value is 700. So the difference, which is 250 rupees on 800 share, would become the taxable value. Correct? So taxable value would be 2 lakh rupees in this scenario. Point number 6. He was provided with furniture during September. Now you can see provided. So that means from September 21, he is using it. The furniture is used at his residence for personal purpose. Actual cost is this much. On 31st March 26, the company offered the furniture to him at free of cost. No amount was recovered from him towards the furniture till date. Now again, this situation for the purpose of use and for the purpose of transfer. In both cases, we need to find out the taxable value. So can you find these taxable value? Please try it. And if there would be a problem, I am going to solve it for you. First of all, find out how many months it has been used. Let me see any answer. Sir, it is included in income from other source regarding what you are asking, Sridhar. Point number 4. No, it is going to be taxed under income from salary only, Sridhar. Mac is saying 55,000 rupees. The taxable value for the use, Mac, you are saying? Look, the asset has been transferred on last day of the previous year, 31st March. So that means for full year, the asset has been used by employee. So 1,10,000 again furniture. This is use value. Now chalo tell me how many completed year is there before transfer. In this question, the asset has been transferred. Kindly tell me how many completed years are there. Gayatri is saying 4 years. Mehak is saying 5. Vishakha is saying 4. Sridhar is saying 4. The correct answer is 4 years. From September 21 till 31st March 26. September 1 till September 22, 1. So on 23, 24, 25. So September 26 would be 5th. It is some 4 year and some months. So 4 year depreciation we have to calculate on it with SLM method. So as the value is 110, 4 year at the rate of 10% would be 44,000. So 44,000 was the depreciation. The remaining value is 66,000. Charged from employee nil. So this full 66,000 is going to be taxable value in this situation. I hope it's clear. Moving on to the next. Received rupees 10,000 towards entertainment allowance. So of course, this is going to be fully taxable. Next is housing loan. Housing loan 4.5% per annum provided by Smile Limited. Amount outstanding is 15 lakh. Rupees 50,000 is paid by Mr. Salesh every quarter towards principal starting from June 25. The lending rate of SBI for similar loan is 8%. So this is very, very important. Very nice question for the purpose of interest on housing loan. When it is going to be treated as perquisite under the Act salary because you have received at concessional rate. So now you will see the total loan value. The interest rate benefit is 8% minus 4.5%. So 3.5% is the interest benefit. Clear? Now this is going to be charged on the outstanding balance at the end of each month. Now the loan was 15 lakh and the repayment started from the June value and every quarterly. So if you find out in April, the loan would be still 15 lakh rupees. In May 25, again the loan would be 15 lakh rupees. Now from June onwards, because the payment has been made, 50,000 rupees. So the loan remaining value would be 40 lakh, 14 lakh 50,000. This will continue for 3 months. June, July, same value. August, same value. Because the 50,000 payment is on quarter basis. So firstly 50,000 paid in June. So the value of outstanding balance would reduce to 14 lakh 50,000 from June onwards. Then from September it will change. Now it's 14 lakh because from September the second installment must have been paid. October it will remain 14 lakh. November 14 lakh. Now from December onward, again, it is going to change 13.5, January 13.5, February 13.5, and from March, again, this is going to be changed. So when we have gone through with the interest calculation to find out the taxable value of this perquisite, in our normal class, I have told you you have two options to calculate the taxable value of interest. Either apply this concession of 3.5% on each value separately. And aggregate of these value would be your taxable value. And there is one more method. Aggregate this whole amount which is outstanding at the end of each month during this previous year. So the aggregate of all these value would come to rupees 169 1,69 lakh. On this value directly, we can calculate this interest for 1 month only. Either you need to calculate interest of 3.5% on each value for 1 month, and then aggregate would be your answer. Or you can do this on the aggregate value of this loan outstanding for 1 month. This would be 49,291. So this is your taxable value of interest. Facility of laptop given 50,000, nil taxable value. Now the gross salary would be 15,22291. The deduction we can claim would be standard deduction that amounts to 50,000. So the remaining value is 147,2291. That would be our salary, taxable or net salary. Any query, student, in this? Simran is saying, so then we need to ignore the months above 4 years. Yes, because the provision says you just need to take complete years. All months would be ignored for the purpose of that perquisite. Entertainment allowance deduction is only available, Gayatri, for government employee. And because he is not a government employee, so entertainment allowance deduction we cannot claim in this question. Understood? Any query, student, in this question? What we have just gone through? Let me tell you this point number 8, what we have just solved regarding the taxable value of perquisite in case of concessional loan is very, very important. Please mark it properly for your examination, etc. Sure. Next, question number 6. Mr. Kamal, a resident but not ordinarily resident in India during the assessment year 26-27. So the residential status has been already provided. He owns 2 houses, one in Dubai and the other is in Mumbai. The house in Dubai is let out there at a rent of 20,000 per month dirhams. One is equivalent to 22 rupees INR. The entire rent is received in India. Is paid property tax of 2,500 and sewerage of 1,500 there. The house in Mumbai is self-occupied. He had taken a loan of 10 lakh to construction of the house 1, June 22 at rate 12%. The construction was completed on 31st May 24 and he occupied the house on 1st June 24. The entire loan is outstanding as on 31st March 2026. Property tax paid in respect of the second house are 2400. Compute his income under regular provision of the Act. So now, as you can see, We have to solve this as per optional tax regime. First of all, let's solve the property which is in Dubai. Because the rent is receiving in India, so the amount is going to be taxed in the hands of resident and not ordinary resident. The rent or the GAV would be 20,000, 12 into 22. So the GAV would be 528,000. Less municipal taxes paid there. That is 4,000 into 12 into 22. And you can see the municipal taxes is annually. So there is no calculation of monthly required to be done. It would be 88,000. This is 519,200. Standard deduction 30%. That would be 155,7600. So the value of this house property is 36,344,000. Now moving on to the property which is used for self-occupied purpose. That is, annual value would be nil. And the interest calculation of current year interest and 1/5 of pre-construction period we have to do. Because the loan has been taken for rupees 10 lakh at the rate of 12% and nothing is repaid. So current year interest in case of self-occupied property would be 1,20,000. For the purpose of 1/5 of pre-construction period interest, we have to find out first of all pre-construction period. That is going to be started from 1st June till 31st March 24. So the pre-construction period interest would be 2,20,000. 1/5 of this can claim as deduction, that would be 44,000 rupees. So this is loss of 44 and the current year interest we have calculated 120. So loss under this house would be 164. Clear? Now this loss can be set off against the income of Dubai property, which was 363,440. And after setting off, the net income from house property would be 347,0400. This kind of question we have just solved, I guess. That was question number 1, part of house property, I believe. So student, is there any problem in this question? If yes, please let me know. Anyone is having any issue in this question? No. Very well done. Moving on to our next question. Mr. Yogesh construct a house in previous year 17-18 with 3 independent units. During the previous year 25-26, unit 1, 50% of the floor area is let out on a monthly rent of this much. Rent of January 26 could not be collected. from the tenant and a notice to vacate the unit was given to the tenant. The other property of Mr. Yogesh is also not occupied by the same tenant. Now, Unit 1 remains vacant for February and March. When it is not put to any use, Unit 2, 25% of the floor area is used by Mr. Yogesh for the purpose of his business, while Unit 3, the remaining 25% is utilized for the purpose of his residence. Other details of the house are as follows. You can see municipal valuation of the full property has been given, which needs to be divided into three parts. One property is having 50% ratio, other two is 25-25. Same in case of pay rent, same in case of standard rent, same for municipal taxes paid, same for interest. The fire insurance, ground rent, etc. are not eligible for deduction. Business income has been given. You have to calculate under default tax regime the income of Mr. Yogesh. As you can see, there are three properties. One is let out, one is used for business, and one is self-occupied. So the let out property is consisting 50% of the area. 125% unit is used for his business. So no treatment under income from house property. The third is again used for self-occupied purpose. As you can see, we are solving this question under default tax regime. So there could be an interest portion reduction available against third unit. But because we are under default tax regime, so interest deduction cannot be claimed. So the value of third house would be nil. Second is not applicable under income from house property. So the whole focus should be on the first property, which is 50% let out. Clear, student? Now we will solve this part. This is a case. Can you tell me, after reading this question, whatever information we have, can you tell me which case does it fall? That means whether it's a let out case, deemed let out case, unrealized case, vacancy case, whatever it is. So just read the question and let me know whether this case is falling under let out, deemed let out, unrealized rent, or vacancy case with let out. Mac is saying case number 5 directly. बच्चों देखो, when we have in a normal class, I have told you this is F case when let out and vacancy is there. And I have told you at that time also, do not write like this in the examination. If the question in the examination, do not write, let's solve this as per case number F. There is no case number A, B, C, D, E, F, G, H, I, J, K, L, M, N. Okay. This is for your concept that when you realize this is a F case, you will be sorted that how we are just going to solve, what content, what kind of GAV calculation I need to put it. Okay. Absolutely right. It's a F case. That means when let out and vacancy is there. For that purpose, first of all, we have to calculate GAV as per normal case, municipal value and pay rent. So the question has been mentioned municipal value pay rent. We will take the 50% of it. That would be 144. This is pay rent 130. Sorry, 149. So out of 144, 149 higher needs to be taken. 149 needs to compare it with standard rent. 50% would be 139. Need to take the lower out of it. So the lower value would be 1,39,000. Now under vacancy case, when we compare this lower value, we need to take annual rent on the basis of rent paid. So the annual rent would be 2,40,000 in this case. 20,000 into 12. From this, we need to reduce any unrealized rent, if any, in the question, which is for 1 month. After reduction, now we can compare this with the lower value as we have find out from above provision. Out of these two values, the higher need to be selected. The higher is 2,20,000 rupees. But this is not going to be your GAV because now we need to reduce the vacancy time duration from this value. So how many months the property was vacant? The property was vacant for 2 months. So 40,000 needs to be reduced out of this value and the balance 180 will become your GA. Understood? From this GAV, now we need to reduce the municipal tax portion. That would be 15,000. Balance is 165, your net annual value. 30% deduction would be there, 49,500. And 50% of interest portion, 45,000. Remaining value is 70,500, your income from house property. It's a very good question for your revision purpose of F case, etc. So, is there any problem in this solution, students? Please let me know. Either is saying no issue, very good. So please mark these kind of question for your revision purpose also. That is really going to help you during the examination time when you don't have much time for revision. So only those selected questions, selected points which are important, which are not general, which are special cases, only go through that numericals. You have to revise all the theoretical provision. But for numerical also, please attempt those questions. Those are having these kind of characteristics. Those are very interesting and important. Moving on to next question. The particulars given below are of Mr. Radhe's income. Age 47 years, posted in a private company in Delhi for the previous year 25-26. Basic pay 35,000 rupees per month till January 31, 26, and after that it's 40,000 rupees per month from February. Dearness allowance 30%, out of that 54% as per term. His employer gave a rent-free accommodation, okay, the employer also spent 50,000 on refresher course, etc. First of all, we have to see what is the requirement of question. So you have to calculate the salary under default tax regime. So this is solution for default tax regime. So the income, the basic salary is in two parts. 35,000 per month for 10 months and 40,000 for 2 months. So the aggregate would be 4,30,000. DNS allowance is 1,29,000, out of which 54% is as per terms of employment. Now the rent-free house accommodation provision. It would be 10% of salary because house is in Delhi. So for the purpose of salary, we need to consider 4,30,000 and 54% of this 1,29,000. That is 69,660. The aggregates 10% would be 49966. Now the next point is saying the furnitures also provided with the house were bought by the employer. The cost is 150. So because you have furnished rent-free house, 10% per annum would be the taxable value for furniture in this situation. Electricity bill 4,000 per month paid by employer. It is an obligation of employee paid by employer going to be taxed completely. Now, can you tell me the treatment of point number 4 and point number 5? Very simple point. Just try to read it and let me know the treatment. Gayatri is saying non-taxable on training. Okay. Anyone else? Non-taxable for point number 4 as from Dhanlakshmi. Fourth point is not a work. Okay. What about point number 5, student? Non-taxable as per Dhanlakshmi. Can anyone tell why point number 5 is non-taxable? Why? What is the reason it is not taxable? Simran is saying notified hospital and as well as the specified disease. Both conditions should be satisfied. Of course, refresher course is non-taxable, and this is also non-taxable due to the specified disease in a notified hospital. So the gross salary would be 671,966. And as we are under default tax regime, the deduction would be 75,000. Balance is 596966. That would be our net salary or taxable salary. Any problem in this question? Any query? Please let me know. Yes, correct, Mahak. Correct, Sridhar. Correct, Lakshmi. You have given the correct answer. Aditya is saying clear, sir. Very good. So I guess this is now time for a short break. And when we will be resumed, we'll be having some more question from MTP and RTP and case scenario. So Ashok sir, can we take a short break? You must have your coffee, tea, etc. And we were discussing the provisions of and the questions of house property and salary head. The last question we have discussed. Now moving on to the next question. That is question from your RTP. A very interesting question and having a very unique case in respect of rent-free house. Let's understand this question. Nisha is a marketing manager in Rose Limited. She gives you the following details for the previous year 25-26. Basic salary 45,000, DNS allowance 10,000, 30% is for retirement benefit. Bonus 1 month salary. So before solving further, let me see what is the requirement of question. Compute the income chargeable under the head salary under optional tax regime. Now, the contribution 18% towards recognized provident fund is there. Motor car details has been given for taxability of motor car perquisite. Company pays medical insurance. Now you will see a very interesting point in this question, that is point number 7. Our employer gave him a rent-free accommodation in Mumbai from 1st April 2024. The house was taken on lease by Rose Limited from rupees 12,000 per month. The perquisite value of such accommodation for the previous year 24-25 was 55,000 rupees. Now you can see this is something unusual. Why the previous year taxable value of perquisite has been given in the question. And more interesting, the cost inflation index for previous year and preceding previous year both has been given in the question. Generally, we use cost inflation index in case of capital gain question for the purpose of indexation. But now this is a very unique case that you need to apply the cost indexation under salary head for the calculation of rent-free house. So this cost inflation index have to apply in case of salary. How it is going to be done, we will discuss it later in this topic. Yes, restriction point up to previous year. Well done, Abhimanyu. So now one by one, we will take our things. First is basic salary is 45,000. So total would be 5,40,000 rupees. DNS allowance 10,000 per month, 1,20,000, out of which 30% is as per terms. Bonus, which is equivalent to 1 month basic salary. It would be 45,000 rupees. Now the contribution to RPF, the concept says up to 12% of basic salary and DA terms is exempted, but any excess would be taxable. So let's see what is the contribution. The company contribution is 18% of her basic salary and DA, as the question mentioned, basic salary and DA. So the 18% would amount of rupees 118800. That would be 18% of basic salary and DA if you will calculate. But the exemption would be now up to 12% of basic salary and DA as per term only. So if you will calculate the 12% of your basic salary and DA term part, that will amount to 69,120. The taxable value would be 49,680 in case of recognized provident fund. Now the motor car facility. Motor car owned by the employer. Cubic capacity of engine exceed 1.6 liter. As we have discussed in our normal classes, there are three most important factors which is important to find out the taxable value in case of car perquisite. Who owned the car, the capacity, and who is bearing the expenditure. So all the expenditure met by her. So on the basis of these three things, we will find out the taxable value. So car has been provided for both purpose. And of course, the purpose is also important. So then who is having the car, the cubic capacity, who is paying the expenditure, and the purpose for use all are relevant to find out the taxable value. And we need to calculate this from 1st November 2025 till 31st March. So the calculation would be for 5 months. Now in this case, you can see car owned by employer, capacity is 1.6 liter, provided to Nisha from 1st November 25, which is used for both purpose. Expenditure paid by employee. So the taxability would be 900 rupees per month. So for 5 months, this value would be 4,500 rupees. Next is the company pays medical insurance premium of rupees 18,000 to affect insurance on the health of Nisha. So what is going to be the treatment in this case? Whether this is going to be exempted or taxable. Tell me, student, this is going to be exempted or taxable? That is exempted. Well done. This is not going to be taxed. This is going to be exempt. Now the most unique perquisite is here. Her employer gave him a rent-free accommodation in Mumbai. The house was taken on lease by the company. So if the property is on lease, the taxable value would be always 10% of salary or lease rent paid by employer, whichever is lower. On this basis, we have to calculate our salary, and the salary would be the rent paid is 12,000 rupees per month, and the salary would be 45,000 plus the value, which is 30% term value and full bonus value 45,000. So the aggregate of all these 3 points would constitute 6,21,000, and the 10% of this would be 62,100. The rent paid is 12,000 per month, so the annual value would be 1,44,000. Lower would be your taxable value. Lower should be your taxable value. That would be 62,100. But now this is a very interesting case. This value, due to this sentence, there is a new concept applicable, the new treatment we need to understand. If the rent-free house has been provided by the employer to the employee in previous year also, as in this case, the previous year value is taxable value was 55,000. So if you have the rent-free house from your employer in the previous year also, preceding year, that means in 24-25, then the taxable value you have find out for 25-26 needs to compare with the taxable value of preceding year, which would be given in the question. As in this question, it is given 55,000. But there is a very interesting point in this. So the taxable value of 24-25 was 55,000, and the current value is 62,100. But whatever was your taxable value of the preceding year, you have to do the indexation of that value with the help of cost inflation index. So as the 55,000 value was belonged to last year, the index of which was 363. And for the current year, this value should be. So technically what we are doing the indexation of taxable value of rent-free house of preceding year. So the cost indexation index would be given in the question. So now this value would be 56970. And now you will compare this value with 2526 taxable value we have found. Lower is going to be your taxable value. So the lower value is 56970. This is a very unique case. So if the rent-free house preceding year value has been given in the question with the cost inflation index, kindly index that value, and now that value should be compared with the current year rent-free house taxable value, what you have calculated. And the lower is going to be your taxable value. In your study material, this provision has been mentioned on page number 3.77. And if you read it theoretically based, so you might feel it very technical, but now please read this point with the help of the example we have just solved today. So if you see the solution, whatever we have just gone through, and if then you will read this part of the perquisite treatment, you will be able to understand it very clearly. What it says? It says where the accommodation is owned or taken on lease, rent by the employer, and the same accommodation is continued to be provided to the same employee for more than one previous year. The value of perquisite calculated in serial number 2, that means the current year perquisite value above, shall not exceed the amount so calculated for the first previous year as multiplied by the amount which is the ratio of the cost inflation index for the previous year for which the value is calculated, and the cost inflation index for the previous year in which the accommodation was initially provided to the employee. So might be this language could be difficult, but if you simultaneously with the language and the question what we have just solved, that point, read together, you will be able to understand the meaning. And let me tell you, it is as simple as that. You just need to do one thing. Kindly index the value of preceding year taxable value of rent-free house. Just index this value with the cost inflation index. And then compare this with current value, what you have calculated. Lower would be your taxable value. Understood? Next is, company incurred expenses on the treatment of her daughter abroad, including stay expenses of 150 as permitted by the RBI. So this is going to be exempted because it is stay expenditure is exempted if permitted by RBI. The 9th point, again, it's very interesting. We have discussed it. Company also incurred expense in relation to the foreign travel for medical treatment of daughter of rupees 80,000. So in case of medical treatment outside India, there is a very special provision regarding the traveling expenditure taxability. Can you tell me what exactly that was in short? The traveling expenditure could be taxable if certain conditions are satisfied. So can you tell me what exactly was that provision in short? Let me see who is going to tell. Abhimanyu, less than 8 lakh rupees income. Simran, if GTI is more than 8 lakh rupees, absolutely correct. If your GTI exceed 8 lakh rupees, then the travel perquisite regarding medical treatment, which has been exempted earlier, is going to be taxed again. So for the purpose of this taxability of this 80,000, we need to see what is our gross salary, in this case, our income. Let's see this. The calculation we have already done. One by one, we have to write it down. So the basic salary was 540, your DA was 120, 45,000 was bonus, provident fund is 49680, 4,500 rupees was your perk or car, your rent free house is 56970. And after considering all this, the gross salary would be 816,150. But you will have a standard deduction of 50,000 rupees. So after that, your gross salary would be 766,150. So that 80,000 of travel perk will still remain exempt. Suppose if this value is 8,66,150, then again this 80,000 is going to be taxed and your income would be increased by 80,000 rupees. That was the exempted value of the perquisite. I hope it's clear. Yes. So that was the RTP question. Now we will be moving on to some case scenario questions, one by one. Again, let me tell you, our next class would be on, I guess, 22nd of June of PGBP head. So I would like to request to all of you, please revise the provision ones. Because if you will revise them, it would be really easy to all of you to understand what practical provisions we are solving right now. As I have requested you all in the last session, if you have revised house property and salary and joined today, I can assure that those who has done the revision of these two topics must have getting a lot more from this class. And of course, the concept must be going more clear. So this PDF is uploaded. No, Mehak, there was some site issue. So I was not able to upload the answers of the last PDF. And also I was not able to upload this PDF. So as soon as that problem would be solved, I will upload it as soon as possible. Okay. So next question is, Mr. Rajesh, age 54 years. So first of all, in case of multiple choice question, we have to see what is the requirement of first question. The first says, what is Mr. Rajesh Sharma residential status for the assessment year 26-27? So I believe in this case, this is the part of residential status, so we are not going to solve it. But as soon as you can see, in this case, the status would be resident. So this is, we are not going to solve, we are solving from point number second. What are his residential perquisite? What are his taxable perquisite for assessment year 26-27? So let's see. The correct option of this is A. Okay. We have to find out the taxable perquisite out of this question. One by one, we will find out the perquisite and will find the taxable value. Basic salary, DNS allowance, monetary payment, bonus, monetary payment, medical allowance, monetary payments. So from D point, the perquisite start. First of all, he was also reimbursed with the medical bill of his mother amounting to rupees 15,000. So tell me whether it's going to be a taxable per or not. Taxable, taxable. Simran is saying no. Why no, Simran? Abhimanyu is saying, I have a small request. If possible, in this question sheet of next session provide. So we can try first before attending next session and also check our answer class. I will upload. Okay, no problem. This is going to be completely taxable because this medical facility is not from employer maintained hospital, not for a specified disease or not from a government hospital. So this is going to be a taxable perquisite. He was also transferred a laptop by company for rupees 15,000 on 31st December 25. The laptop was acquired by company on 1st October 22. Company was charging depreciation of this rate. Estimated useful life of laptop 3 years. So now the company purchased this laptop on 1st October 22 and transferred you on 31st December 25. First of all, find out completed years. How many completed years are there? 2, 3, whatever it is. Let me know. Yes, correct. Gayatri. Correct, Sridhar. Correct, Mehak. It's 3 years. So for the purpose of laptop, now we have to charge 3 years depreciation at the rate of 50% on WDV basis. So the value was 1 lakh. First year 50. Second year 25,000, sorry, 50% rate. Amount would be 25,000. Third year 50% rate. Value depth 12,500. So balance is 12,500. Now this laptop has been transferred for 15,000 rupees. So employee purchased the value of laptop of 12,500 rupees after paying 15,000. So is there any perk or not? There is no perk, is it? Because as per the rules, he does not have any benefit from this laptop. So the taxable value would be nil in this case. This rate is not relevant, it's just to make you confused. He also reimbursed salary of house servant 4,000 per month. So of course, 48,000 is going to be a taxable value of perquisite in this case. Professional tax paid 2,400. Also a perquisite value in this case. 15,000 was this perquisite value. Till now, 3 taxable value of perquisite we have find out. The next and the last is point number H. 400 equity shares he purchased at 250 rupees from the company. Market value is 350. So 100 rupees benefit on each share. So that would be 40,000 rupees. The total taxable value of perquisite in this case 105,400. That would be the correct answer, and that would be option number C. The third point is, what is the income chargeable under the hack salary? So now you have to calculate the full salary. So as we have seen, the basic salary is, in this example, 696,000. DNS allowance has been given 10%, which is as per terms 69600. Bonus has been given 98,000 rupees. Medical allowance is taxable 60,000. As you can see, these 4 informations are very simple. Basic salary we have calculated. DNS allowance we have calculated. Bonus calculated. and allowances. Except these four, only the perquisites were there. And we have already calculated the total value of perquisite. So we can use it over here directly. After adding this would be 1029000 less standard deduction of 50,000 and professional tax, because we are under optional tax regime, so we can claim professional tax deduction also. After this, you will find out your answer. That would be option number A, 976600. Fourth is for tax liability. That is not going to be covered under salary topic, what we are discussing. And fifth is also for tax liability calculation. Next case scenario. Any problem in the previous question we have solved? No, clear, sir. Very good. Mr. Hardik, 45 years age, is appointed as senior executive. Let me see what the question is. Based on the above fact, the first question is, you have to find out the rent-free accommodation value. So first of all, we have to find out the rent-free accommodation value from this question. As you can see, this is the range-based question. How to solve this range-based question? We have seen that in our normal class. He is appointed as on 1st February 2025 on the scale of 35,000, 3,500 and 65,000. He is paid dearness allowance at the rate 40% of salary forming part of retirement benefits. He is given rent-free unfurnished accommodation on 1st October 25. The company pays lease rent of 5,000 per month. So I guess there is nothing else regarding rent-free house except this information. So because the company is paying lease rent, so the concept would be 10% of salary or lease rent, which is 60,000. Sorry, not 60,000 because house is from October, November, December, January, February, March. That would be 30,000, 6 months rent value. Lower would be taxable value. For that purpose, we have to calculate the salary, and the salary should be calculated from 1st October 25 till 31st March 26. For this purpose, we have to see that according to this range, what would be the salary during this duration. So let me tell you, on 1st October 25, the salary would be 35,000 per month. And it would be same up to January. So December, October, November, December, and January. For 4 months, the salary would be as per 35,000 rupees per month. And from February and March, after the increment, it would be 38,500 for 2 months. Aggregate would be 217,000. 40% is dearness allowance as per retirement term. Of this value needs to add 86,800. The salary for rent-free house would be 303,800 and 10% of it, that would be 303,800. Compare with 30,000. So the lower taxable value would be 30,000 in this case. This would be the taxable value in case of rent-free house. Clear? Any problem in this solution? Any problem, student? I guess no. Let's see. Mac is saying, sir, when solving, how to write. So the solution sheet, when I will upload, you can see the way of solving these questions, and there would be a class specifically to make you all understand how to write an examination, what should be the pattern of answer, what should be the sequence of answer, etc. So in that class, you can ask these kind of questions. Okay, next, the car perquisite value we have to find out. He has been provided a car of above 1.6 liter capacity, which is used by him for private purpose only. The actual cost of the car is rupees 8 lakh. The monthly expenditure of car is 5,000, which is fully met by the employer. The car is owned by the employer. So can you tell me how to calculate car perquisite in this situation? Which case we are actually discussing? Car is owned by employer, expenses paid by employer, and car is only used for private purpose. So what is the tax treatment when car owned by employer, expenses paid by employer, and it is used for only for your personal purpose? Vishaka is saying 10% of cost plus expense. Well done. The Lakshmi actual expenses table. So when the car has been utilized for only personal purpose and owned by employer, and expenses is also met by employer, in this case, the taxable value would be actual expenses paid by employer and 10% of the cost of the car. So the actual expenses 5,000, so total is 60,000. And the car value was 8 lakhs, so 10%, 80,000 would be there. So this is 1 lakh 40,000 rupees taxable value. Clear? Any confusion is this? Very good. Sure. Next question. Other parts are for tax calculation, etc., not for salary house property. Ananya Gupta, a citizen of India, lives with her family in New York since the year 2000. She visited India from 21st March 25 to 28th September 25. So let me see what is the requirement of question. Residential status, we are not going to solve, but she is a non-resident. The correct answer is non-resident. Okay. Question number 2. Ananya Gupta can claim benefit of nil annual value under section in respect of. The question is asking, out of the houses she owned, which house value she can claim nil? Her Delhi house, Mumbai house, or New York. So for that purpose, we have to find out the scenario, what exactly question has given to us. In the last 4 years, so we know that the status is non-resident. In case of non-resident, only those incomes are taxable, those are received in India, or those are arise in India. Clear? She owns an apartment in New York. So she is having a house at New York, which is used as her residence. The expected rent of the house is $32,000 per annum. The value of $1 may be taken 75. Municipal taxes paid in New Jersey is so and so. So let me tell you, because she is a non-resident and there is no income received in respect of this house in India, so there is no taxability, because in case of non-resident, we cannot consider any income of any property if the amount is not received in India. Now we have left with 2 houses only. And out of these 2 houses, we have to find out which is going to be taken as nil. She took ownership and possession of her house in New Delhi on 25th of March. Clear? For self-occupation. So New Delhi house is for self-occupied while she's in India. Municipal value is 420, fair rent 450. She paid property tax of 22,000. She has taken a loan of 16 lakh, etc. for constructing. No amount has been paid toward the principal amount, etc. She had a house property in Mumbai also, which is sold on 28th March 25. In respect of this house, she received arrear of rent of rupees 3 lakhs. So technically, this house she does not have in financial year, or we can say previous year 25-26. So in 25-26, she is only having two houses. One was in New York and one is New Delhi. This house we cannot consider because that is outside the purview in case of non-resident. So only she is having one house as self-occupied. So we need to take this value as nil. Then why this house value of Mumbai has been given? Because from this house, she received arrear of rent 3 lakh in this financial year on February 2026. So the answer of first question we have, her Delhi house should be treated as nil value because New York house is outside the purview and Mumbai house is not here in the financial year 25-26. What is the income chargeable under the head? So there was a house in New Delhi and Mumbai. So technically Mumbai was no house, actually area received. That's why we are writing it down like Mumbai area received. What is the income chargeable under the head? So the New Delhi house value would be nil because it was self-occupied. And we can claim interest deduction as follows. Current year interest, that would be 1,60,000 rupees. And if you will calculate the 1/5 of pre-construction period interest, that will come 96,000 rupees. So the aggregate is more than 2 lakh. So we will restrict this deduction up to 2 lakh. So loss from this property would be 2 lakh. Now the area she received, 70% is going to be taxed. That would be 2,10,000. So the final income of house property would be only 10,000 rupees in this scenario. Any query in this student also? Okay, moving on to the next question. Case 4. We have given building at Chennai, building at Kochi, municipal valuation, etc. has been given. Municipal taxes paid by tenant, Mr. Ramu for building at Chennai and paid by Mr. Sonu for the building at Kochi. So tenant municipal tax cannot allowed as deduction. Only owner municipal taxes paid can allowed as deduction. Repair expenditure, land revenue, insurance premium, interest on loan borrowed for payment of municipal tax. This is let out for resident, this is let out for business. So both are let out, both going to be treated as same part. Completion completed, construction completed. Now what is the requirement of question? The first MCQ says, which of the building income is chargeable to tax under the head house property in the hands of Mr. Sonu? So the correct answer, out of these two properties, you can see the property which is in Mumbai, the Sonu is constructing one more building in Mumbai during the previous year. So that building is still under construction. And if something is under construction or any property which has not been completed, that cannot be the part of income from house property. So only two properties let out from Chennai and Kochi would be taxable under the head income from house property. So the correct option is option number C. Sridhar is asking whichever is less or high in car case, previous case scenario. Whichever is lower, we need to take. In case of car, that was not car case. In car case, both need to be taken because car is for private. So expenses as well as 10%, both needs to be aggregated. Both are going to be taxed. Okay. Which of the following payments expenditure is allowed as deduction while computing income under that house property incurred in respect of the building at Chennai and Kochi? So the case in which the municipal tax is paid by the owner, only that can be allowed as deduction. So option C would be applicable. Next is under which head of income the amount received from Raju would be chargeable to tax. So point number 3, it says from Raju we received the rent for the building which is under construction. So can you tell me if somebody is receiving rent from a building which is under construction, under which head that is going to be taxed? Anyone? Abhimanyu is saying other source. Aditya is saying business and profession. And Lakshmi is saying other source. So technically, if the house is not completed, this is going to be treated as a vacant plot or a land. And any rent received from a land would be taxable under income from other source because this is not your business activity. So the correct answer is this. Now, what is the amount chargeable to tax under the head income from house property? Let's solve this part. Chennai property and Kochi property. If you will calculate the municipal value, pay rent, etc., the GAV of Chennai property would be 38,000. As municipal tax is paid by the tenant, so would not allowed as deduction. Out of this, we can claim 30% deduction of 11,400. The taxable value would be 26600. In case of Kochi, the GAV would be 70,000 rupees. And because municipal taxes is paid by owner, 4,000. That is allowable as deduction. So the net annual value would be 66,000 rupees. Out of this, we will reduce our standard deduction of 30%. That would be 19,800. The balance 46,200 would be your income from house property. The aggregate of these two income would be 72,800 rupees. So option A is going to be the correct answer. Any problem in this question, student? Sridhar, you have answered 7,28,000. Okay, I understand it was by mistake. Next step. Question number 5. Mr. Ganesh. So you can try this question by yourself, student. I would like to see if there is any query you can ask. If you have any query, please ask. For the purpose of salary and house property cases, as I have told you in the starting of the class, let me tell you once again, you have to be very careful that in which regime we are going to solve this question, whether under default tax regime or under optional tax regime. Because under these two different regimes, the provisions are completely changed in case of salary head as well as in case of income from house property. So please, whenever there is a question, be very careful about the regime under which you need to solve that question. Okay. So if there is any query, please ask the student. It seems there is no query is there. So Ashok sir, can we close the session? Okay, one query is there. Let me see what it is. So entertainment tax have taken in DTR, but why OTR will taken? Sir, entertainment tax, what is Aditya entertainment tax? That is entertainment allowance is there. Entertainment allowance is taxable in both cases, but the deduction of entertainment allowance deduction can only be claimed if you are a government employee. Understand? And you are opting for optional tax regime. You're welcome. Saurabh is saying, sir, can you please a small discussion about unrealized rent? Yes, why not? Saurabh, unrealized rent is the rent which has not been recovered by from a tenant, which has been used our property, but he did not pay a certain month's rent to us. You can understand it in a simple way, just like a bad debts in case of business. If you have sold your goods to someone, he becomes your debtors and then he did not pay it. So we done as bad debts written off. In the same way, in case of house property, our debtor is our tenant. So if he reside in our property and did not pay rent of any month, then that rent become unrealized rent and it will not be the part of our actual rent received provision for calculation of gross annual value. But if in future that unrealized rent is recovered from that tenant, that is going to be taxed under the head income from house property in the year of realization. And after 30% deduction of a standard deduction, the balance 70% is going to be taxed under income from house property, even if the house from which it relates, whether you are the owner of that house, is still in this year or not. It does not make any difference. Is it clear, Saurabh? Welcome. So unrealized rent deduction will available only if certain conditions are fulfilled, Abhimanyu, and that has been discussed in the normal classes and also specified in the notes. General conditions are that that tenant should not occupy our any other property. We have taken all the steps, legal step to recover the rent. Still, we are not able to recover the rent. So on. Okay. Ashok sir, can we close the session now? Yes, yes, over sir. Good night. Good night.